All right, let's dive right in. Today, we're exploring what the national debt crisis actually means for your daily life. It's one of those issues that constantly dominates the news cycle, yet for most of us, it feels totally disconnected from our own reality. But today, we're going to unpack the absolute truth about the national debt crisis.
Look, you see 35 trillion flashed on a screen, and honestly, our brains just aren't wired to comprehend numbers that massive. While those trillion-dollar headlines seem completely disconnected from our day-to-day lives, we're going to look at the exact math on how this huge macroeconomic issue directly squeezes your personal finances. Here's our roadmap for this explainer. 1. The trillion-dollar reality. 2. Drivers of the debt. 3. The boa constrictor squeeze. 4. Impact on everyday consumers. 5. What it means for investors. And 6. An unsustainable fiscal path.
Section 1. The trillion-dollar reality. Let's establish the current landscape.
We're looking at a staggering baseline here. The total U.S. debt has nearly tripled in just the last 20 years. We've skyrocketed from $12.26 trillion back in 2004 to over $35.46 trillion in 2024. This isn't just some slight upward trend. It's an explosive acceleration that really kicked off in the 80s, got supercharged by the 2008 financial crisis, and has basically been climbing ever since.
Now check out this debt-to-GDP ratio, that massive 116% right there. This is the size of the debt compared to our entire economic output. It's essentially comparing what the country owes to what the country actually makes. The Congressional Budget Office projects this ratio will hit a record 116% by 2034. To put that into perspective, that surpasses the all-time high levels of public debt we had right after the massive spending required to win World War II.
And because of this unprecedented trajectory, Moody's actually officially downgraded the United States credit rating. They lowered it from AAA down to AA1. Why? Well, they specifically called out large fiscal deficits and declining debt affordability. When the financial agencies that grade a nation's fiscal health start waving red flags, it's a pretty clear signal that the underlying mechanics of our economy are under severe stress.
Section 2. Drivers of the debt. Let's look at the math behind the problem.
So what's actually driving this mountain of debt to keep growing regardless of who is in political office? Well, put neutrally and simply, it's a structural imbalance. The red side of the ledger is just way heavier than the green side. Our spending on government programs, plus the interest on our past deficits, simply outpaces the revenue we bring in through taxes. We are just persistently spending more than we collect.
It's a perfect storm, really. It's driven equally by massive, albeit necessary pandemic stimulus spending, the extension of tax cuts that have reduced federal revenue, and the rapidly rising costs of Medicare and Social Security as our population ages. Add in the compounding interest on the debt we already have, and you get a widening deficit.
And speaking of that interest, get this. The government spent almost $1 trillion on interest payments alone last year, just on interest. That means net interest is now the third largest federal spending category. It actually exceeds what we spend on national defense, and it's almost as much as we spend on Medicare. That is $1 trillion soaking up funds that could otherwise be used for productive priorities like infrastructure or new technology.
Moving to Section 3, the boa constrictor squeeze.
I absolutely love this analogy from Brett Loper over at the Peterson Foundation. He likens this to a boa constrictor squeezing its prey. The debt isn't a sudden explosion or some dramatic overnight market crash. Actually, it's more like a slow, creeping suffocation of economic growth. You might not feel it immediately when you wake up on a random Tuesday, but the pressure is constantly tightening. In economics, we call this the crowding out effect. See, as the government demands more and more capital to fund its massive deficits, it literally crowds out everyday businesses and consumers. There's only a finite amount of money out there looking to be invested. If the federal government soaks up a massive chunk of it, there is simply less money available for private, productive uses. Section 4. Impact on everyday consumers. This is where it gets real.
Let's translate these macroeconomic theories into actual wallet-level impacts, because the projections are incredibly sobering. According to analysis by the Peterson Foundation, by 2035, this current debt trajectory will shrink the overall U.S. economy by $340 billion. Even worse, it's projected to eliminate 1.2 million jobs compared to a baseline where our debt was stabilized. It's a massive drag on the very engine of American prosperity.
And the pain extends right to your paycheck. We're looking at a 0.6% decrease in wages by 2035, which falls even further to a 3% decrease by 2055. A rising federal debt effectively acts as a reverse wage growth engine for American workers. You're working just as hard, but your earning power is systematically being depressed.
What about when you need to borrow money?
Well, the Yale Budget Lab found that just a permanent 1% of GDP increase in the federal deficit translates directly to higher interest rates for you. After 5 years, everyday consumers would pay $600 more in annual mortgage interest and $60 more for auto loans. When the government runs huge deficits, the Federal Reserve has to raise interest rates to keep inflation in check, which makes everything you finance way more expensive. And look at how this builds to a deeply personal level. This chart from the Peterson Foundation shows how the debt burden literally removes $1,000 of income per person from your pocket over the next decade. Look out 30 years to 2055, and that number drops by over $3,200 per person. It is a direct, quantifiable hit to your family's standard of living. Section 5. What it means for investors.
Beyond the consumer pain at the checkout line or the bank, this restricts retail investors in the broader market too. If you have a 401k, an IRA, or invest in the stock market, pay close attention. Because the government is crowding out the market and forcing interest rates higher, the cost of capital becomes just too expensive for businesses. As a result, private investment is projected to plummet by over 13.6% in the next 10 years. Companies literally can't afford to borrow money to build new factories, research new products, or expand.
For investors, this creates a truly toxic recipe. Businesses hold back on expansion because higher borrowing costs make it impossible to predict future profit margins. Meanwhile, a rising deficit stimulates inflation, which steadily erodes your household purchasing power to the tune of $300 to $1,250 a year. You're making less on your investments, and the money you do have buys less at the store.
Finally, Section 6. An unsustainable fiscal path. We have to zoom out for a second and look at the global horizon, because it is vital to note this isn't just an American issue. The OECD reports that sovereign debt in emerging markets has hit record highs, reaching 30% of GDP in 2024. More than half of all outstanding debt in low-income countries is coming due soon, creating a really precarious global financial environment. The whole world is dealing with this massive debt burden, which means the global economic safety net is increasingly fragile.
The numbers we've looked at today prove that the national debt isn't just some abstract government problem. It is your problem. With interest costs soaring to $1 trillion, private investment shrinking by double digits, and average incomes dropping, we have to leave you with one final thought. If the national debt is a boa constrictor, how much tighter can the economy be squeezed before everyday Americans can literally no longer breathe?